Welcome. I'm Beattie, and today we're going to talk about special levies. A lot of you may have heard of this term, and if you've ever been dealt one, you'll know they're not really that special. But to give it some context, across British Columbia, there are about $2 billion of capital projects every year into condo communities, and half is unfunded. That's the magnitude of the problem in British Columbia, $1 billion of special levies a year. I'm going to start with a real world example, and then we'll talk through it together. Imagine you're buying into a condo in a rural part of your province or state for more than $400,000. That's amazingly inexpensive in British Columbia, only to find out that you have to pay the following on top of your condo fees of $350 a month. Now, there's a table there that's quite small, but it shows that for 15 consecutive years, you should anticipate a special levy ranging from $1,000 to $16,000 a year. That's an average of $550 a month. So your real condo costs on top of your property tax and insurance is going to be $900 a month. It's shocking, and the numbers are really real. So what exactly is this special levy? It's a cash call to owners, and it's usually for a capital item. Sometimes there's an operating budget shortfall, an unexpected safety issue, a leak, possibly a jump in your insurance premiums. That happened in this province a number of years ago. The insurance premium rates went up by more than were anticipated, and you had to go out for a special levy to cover that increase in your operating budget. But usually it's for a capital project. And the large projects that you see significant levies for tend to involve the roof, the siding, windows and doors, waterproofing, the major envelope issues, although you can have a levy for anything. And how do you decide how to call one and how does it work? Well, initiation is typically done by the Strata Council or the Condo Board in collaboration with a property manager who will recognize a shortfall and come up with a plan to fix it. Ideally, they can add it to your annual general meeting, but if it's out of cycle with your AGM, a special general meeting can be called. The SGM will allow the community to discuss the scope of the project and to vote on whether to proceed as recommended. It takes a 3/4 majority vote in British Columbia to approve a major project that requires a special levy. And if it's voted down by the owners and a new scope can't be agreed, eventually it might end up with the courts, who can appoint an administrator to carry out the necessary works in the interests of the Strata Corporation. So it's best to be proactive and find the best way to make it work, because those administrators will cost you a couple $100 an hour on top of the project costs. If you can't pay, and you have to pay, your Strata Council or Condo can place a lien on your property in British Columbia. And if you're still unable to pay, they can initiate the proceedings to foreclose. It would take a court order, but your time will be running out if you are hit with a lien and you can't pay it. So what can you do? I mean, first and foremost, get informed and stay informed. I'll tell you a little bit more about how. If you know a special levy is coming and that you can't afford it, plan proactively and make a change. This will require a lot of professional advice. Obviously, you'll want to speak to your banker. You may want to speak to a lawyer. You'll definitely want to speak to a realtor to get an understanding of the current value of your home and what your options might be. And don't blame your strata. We hear this a lot. It's not them. It's you. You're part of that corporation. You're involved in the decisions. If you don't feel like you're as involved as you should be, join the Strata Council. They would definitely appreciate additional involvement and oversight. So do get involved. There are a couple of other options if you can't pay that I'll circle back to later. How do you know what's coming? Well, luckily, in most markets, there's a reserve fund study or depreciation report. I'm thinking mostly from the BC perspective here, but we have depreciation reports that used to be on a 3-year cycle, but you could waive them. And the government's just changed the rules to require them every 5 years. those rules kick in over the next couple of years, depending on where you're based. And that's important because when a depreciation report is stale, there's less predictability about what's going to happen when. But within one of these documents, an engineering firm will set out the expected life of capital assets, the anticipated cost of replacement. They'll make some of their own assumptions on inflation and what the timing and cost is going to be to replace. And they'll give you several different scenarios, a status quo, one that would be fully funded, one that's somewhere in the middle, that will show you when you might get hit with a levy and how much that might be. It's a very useful tool and something that I think everyone should appreciate more than they do. So the answers are usually here. Do pay attention. A stale report is very difficult to get value from because now the asset life and the cost of replacement is uncertain. But let's talk a bit more about our approach to it. At Eli Report, and that's OctoAI's primary consumer tool, we built a special levy forecast into our reports. And there are three critical inputs. The current reserves, that's how much you have in the bank. There's the latest budget with the annual reserve contribution level, because that sets our expectation for how much you're going to contribute into the future. And third is that depreciation report or reserve fund study. We have to make a lot of assumptions that the reserve fund contribution will rise each year, that there's interest earned on the funds that are in that reserve today, and that the engineer's estimates are accurate, meaning both the dollar magnitude and the approximate timing are right, and that work is completed by the Strata Corporation on the timing that the engineer predicted. For many reasons, this results will not be accurate. However, it's better than being completely oblivious, and I always say that it's better to be approximately right than precisely wrong, and that's what I think is really important here. Here's an example from our report output. We've reviewed over 4,200 Strata Corporation depreciation reports in BC and over 500 in Ontario. The Ontario ones are typically a summary, a cash flow table from a notice of future funding. We have some in that style in British Columbia as well, although where possible, we do a line level reconciliation. We've got thousands more in our backlog. This is a big project for us. There's great technology pipelines, but we review this stuff manually to try and get it right. And what we try and show you is what, on an average unit basis, the special levies might be, when and what for. And in this case, you can see that there's a fairly significant special levy coming up for this community in 2027 of nearly $60,000 for a balcony project. A couple of years later, $10,000 for a siding project, and then a dozen years before the next major piece of work where a shortfall is projected. But these tools are there to help you understand when you might see something and what it's for. So how much are we talking? We scaled up the 4,200 stratas that we know about in BC to look at the approximate whole province. That's where that $2 billion number I floated at the beginning came from. Roughly half each year ends up being unfunded, and the average levies per unit per year over the next decade is more than $2,000. The average levy frequency is every 3+ years, and thus when you get a levy, your anticipated levy amount on average is nearly $7,000. This year in British Columbia, we estimated that there were over 130,000 owners going to be hit with levies that were over $7,000. Big numbers. Now let's look in a bit more detail. There are newer buildings, and obviously they've got fewer levies projected because all of those capital items are new. So buildings built after 2020 have only one special levy on average projected over the next decade. It's just less than one. And it's a relatively small amount. But older and more mature buildings have much bigger capital projects coming, and they're not that well funded for them. And you can see that according to our data thus far, older buildings are seeing about 4 levies over the next 10 years, so one every 2 to 3 years. And it's those buildings built in the 90s that are currently seeing the biggest cash calls coming. And that seems a little bit odd, but you got to remember that there are certain assets that last a set amount of time, give or take. And those buildings that are now 35, 40 years old are undertaking some of those most expensive projects relating to their envelope, their windows, their siding, their roof. And some of the buildings that are older than that have been through that major cycle and are not yet at their next one. So by value, the peak levies over the course of the next decade will be for buildings from the 90s. That will change as time goes on. There's also a big difference between building types. High-rise buildings face the highest levies, and that's not unexpected. The cost of doing work in a high-rise is significant. You've got higher numbers of high-value items in them that need replacing as well, elevators, for example. Townhomes are very similar to low-rise communities, and the outlier are those detached communities. So detached homes in an HOA-style community tend to have much lower special levies, but the reason for that is that they're largely responsible for their own building envelope and maintenance. So they're going to be on their own unique cycle, and that's why they look very low in an outward cost of special levies. There's a big provincial difference within Canada and actually across the US with regards to how your projects are funded. Now, Ontario does not have a requirement to be fully funded, but they do mention adequate funding for upcoming expenditures. And what this graph shows is that as a percentage of operating budget, in Ontario, they're contributing nearly 25%, and they still occasionally get levies. In BC, the legal requirement is 10%, and according to our data on average, it's a little over 11. That difference, plus a little extra, is going to be made up of special levies. Now, if we kind of use the math to work it out, it would be about $170 per month per unit extra that BC would be contributing if they approached reserve funding in the same way as they do in Ontario. And that opens some interesting doors and questions. So some will be asking, what's next? First and foremost, get informed. The data is there for you if you live in a community with more than 5 units in British Columbia. So read that depreciation report, get that update done, and be proactive, not only about reading it, but planning those projects. Get onto your Strata Council and get involved with understanding the timing and the magnitude of these costs and events, and push for realistic adjustments in costs so that you are prepared for this when it happens. Now also, and if you can't get on your council, you should be prepared with your own personal financial situation. You have to know what you can afford. There are less frothy times right now in the world of condos, and it's not as easy to sell them for a profit. So you need to look at your own finances and ensure that you're going to be in shape to pay those upcoming costs, or make some difficult decisions that are quite complex for your own financial future. The other thing you can do, and this is both personally and from the condo level, is consider the available funding options. Because of course you've got the ability as an individual to go after a second mortgage, you can seek a line of credit, you can seek alternative forms of lending if you've got what you feel will be a short-term gap to fill. But at the condo level, there is the possibility of using a condo loan to fund some of these capital projects. It's very common in the US, it's far less common in Canada. And one of the reasons that it's less common is that it is more costly to owners on average than if you were able to all get your own funding. But it's a lot easier to get one condo loan lined up than for a couple hundred owners to go off and individually sort out their own mortgage. How much different? From our review, it looks like it's a couple hundred basis points. So it's not insignificant, but it means that you don't all have to go out and sort out that lending facility as individuals. And obviously, it may help those members of your community that wouldn't be able to fund a special levy that can handle the increased burden of repaying that loan and interest as part of their monthly condo fees. There's a big evolution of requirements in the world of reserve funding and reserve fund studies across North America. I wanted to point out Florida, where they had the Surfside collapse tragedy a couple of years ago, and they made some strong and swift moves to ensure that buildings were safe. And to do that, they required structural studies, not dissimilar, but more focused than the depreciation reports that I'm talking about. But those reports sometimes indicated some significant issues that required material funding from owners. And even this week, there was talk about new bills that are offering some relief on reserve funding. Within BC, now that we know it's $1 billion problem, the question is whether BC will move towards improved reserve funding like they do in Ontario. It's, in some senses, a pragmatic choice. If you're willing to fund special projects as they come up, that's one thing. I certainly believe that's how it works if you have a detached home and you're not part of a condo HOA community. But when you are living in a communal setting, it makes sense that you be replacing or paying for the replacement of those capital items as you're working through them and not passing the buck to the next owner after you've used up the useful life of your roof, windows, siding, etc. So there are a lot of big questions that are yet to be answered in this space, but there's no doubt that special levies are a huge topic and one that will be talked about for a long time to come. I'm going to move on to a few questions that have come in during the course of this call. What if I sell after a special levy has been approved? You're welcome to add some questions in, actually. They might sneak through still as we're going. What I can tell you about a special levy that has been approved and you choosing to sell is that the conveyance date is what matters. So anything before that property is conveyed to the buyer is paid by you. Anything after the date of conveyance is paid by that buyer. The special levy will be disclosed within the information package that is available to them. So in British Columbia, we call that a Form B. In other markets, it's called an information or status certificate. Should I move if I don't think I can pay an upcoming levy? Speak to your banker, speak to your realtor and your lawyer for some advice. That professional advice will allow you to ascertain what's realistic in your personal situation. Obviously, you can encourage your community to look at a condo loan. Those are potentially viable options depending on the state of your community, and there's just a lot of considerations in there. Property transfer taxes, capital gains taxes, if it's not your primary residence, and obviously really huge life decisions. So that's a much bigger question than we could answer here, and you should seek that professional advice. Sometimes the depreciation reports are wrong about how long the roof or plumbing system will last. How does that change special levies? Okay, so this is one of the great unknowns. Engineers have a lot of experience. They've got a lot of knowledge about the different systems at play, and they've got many thousands of examples of how long assets tend to last. But if you have a capital asset like this that has a shorter life than expected, special levies will occur sooner, and that the magnitude of those could be higher than you were expecting because you haven't had time to save for them yet. On the flip side, if your roof lasts several years longer than expected, then you're obviously able to defer those costs, which is always a good thing from a financial perspective, giving yourself more time to raise those funds and reduce the amount of special levies. Now, we can often squeeze out a little bit more in terms of asset life, but you're taking higher risk, and that might mean that you end up paying more for your insurance coverage, for example, because you haven't been proactive about maintenance. Someone's asked about what happens to surplus special levy funds. Those get refunded. They get refunded to the current owner. So if you have sold your property and it's now owned by someone else, that excess will be returned to them pro rata in accordance to how much you paid towards that project in the beginning. If it is a small excess, less than $100 per unit, I believe that the Strata Corporation can put those funds right into your CRF towards the next project. But generally, excess special levy funds do get returned to buyers. That's all for questions for today. Next week, I will be joined by Jason Kurtz of Strata West. He's going to join us to discuss what it takes to build a winning team and talk about staff retention in property management. It's another big issue, and I hope that you'll be able to join us. For now, thank you. I'm Tom Beattie, CEO of OctoAI, makers of Eli Report. If you're curious about your own special levies, touch that button or scan that QR code, and you can sign up